Okay, so for this video I wanted to go over the IRS Form 8615, which is used to report the quote Kiddie tax, which is imposed on unearned income of dependent children. So the Kiddie tax is in place because parents for years have tried to shift money, assets to their kids, dependent children that is, and under the belief that, well, if the money's being earned within their account, they're going to have a lower effective tax rate, so we'll pay overall less tax as a family. Okay, so the Kiddie tax kind of steps in here and tries to limit your ability to do that as a parent. So I've got a slide in front of us here, one slide with the rules and some fact pattern we're going to be working with, and then we've got a sample 8615, which we'll walk through to see how to compute the Kiddie tax on this dependent child. So dependents generally only need to file a 1040 if they meet certain thresholds. So a dependent must file a 1040 if their gross earned income, so let's say W-2 wages, was more than $12,550 for the 2021 tax year, so that's the standard deduction, or if their gross unearned income was more than $1,100 for the 2021 tax year. Now, why the difference here? Because the unearned income, if you are a dependent, and you're being claimed as a dependent on another person's return, and you have only unearned income, you do not get the full standard deduction of that $12,550 number. You get a reduced standard deduction, which is only $1,100. And so that's why the filing threshold is lower if you have a dependent child that has only gross unearned income versus wages. So if you're a dependent, let's say you're 16 and you're working a summer job at a restaurant, you make $8,000. The filing threshold you're going to be using is this greater one here, right? Is your gross earned income, your wages, more than $12,550? You're not going to use the $1,100 number unless you have, a substantial amount of gross unearned income, which is the subject of this video. So if a dependent finds that they have unearned income in excess of these thresholds, so more than $1,100, not only do they have to file their own Form 1040, but the taxes would be computed under these Kiddie tax principles, right? So there's two pieces to this. Got to file a 1040, and they got to do the 8615 for the Kiddie tax computation. Now, parents, if they don't want to file a separate return for their kid because it's too cumbersome, they can file an election to report their child's unearned investment income directly on the parent's 1040, right? So the child doesn't have to do its own tax return. The one drawback, well, there's two drawbacks. The first one, though, is this election is only available if the unearned income is only interest, dividends, and capital gain distributions. So if the kid's account has capital gains from the sale of stocks, right? So short-term, long-term, from the actual trading of securities, you can't make the election, right? So those have to be separately stated on the 1040 for the kid, and so this 88.4 election isn't going to be available. Now, the other drawback with making this 8814 election is a lot of times by reporting the tax on reporting the income on the parent's 1040, they lose out on the kid's $1,100 standard deduction, and so the overall tax that you might pay, it could actually be more, and most often is. So in most cases, I see that kids are filing their own 1040, even if it is a 5 or 6 year old child, right? That's just the way the system works. So let's look at the fact pattern here. We have John Doe, and he's a single taxpayer individual, so not married, and he has one son, dependent child, who's 6 years of age. Now, John opened an investment account for his son when he was first born, and he makes yearly contributions to the account under that annual gift tax exclusion. All right, so common estate planning tactic. Now, once the cash is deposited, then it's invested in stocks and bonds, other securities that pay out interest, dividends, capital gain distributions, and the like, right? Now, John also will sell some stocks in there during the year, right? So he trades it occasionally on a quarterly basis. Now, during 2021, he gets the consolidated 1099 for the account, and it shows that the total investment income was $3,485. And that amount was made up of interest, ordinary and qualified dividends, capital gains, maybe capital gains distributions as well. And so all of that's got to be reported on the 1040 for the child, right? And so notice here, again, the standard deduction for unearned income is only $1,100. So because the child's unearned income is over $1,100, got to file a separate 1040. And John cannot elect to treat this investment income as being reported directly on his return because he's got capital gains from the sale of stocks. Remember, it's only interest, dividends, and capital gain distributions are eligible to be reported on the parent's return. So what does John do? Well, the first step is John needs to complete his tax return first. And the reason why we need John's return completed first in its entirety is because on the 8615, we have to report John's taxable income numbers and total tax, because those numbers are then going to be hypothetically adjusted to compute what the Kiddie tax would be or should be on the child's tax return. So John does his return, and he's got total taxable income of $202,718, and his total tax liability is $45,322. Okay, so now let's look at the 8615 and the 1040 for the child. So before we get into the 8615, I want to look at the 1040 first. So we've got the 1040. This is for the child, remember. We've already done John's. So it's a standard 1040, right? We've got the name, address, social security number for the child, single filer, right? 6-year-old, not married. And then down here, the standard deduction. This is important, right? He is being claimed as a dependent on another person's return. And that's important because that drives what the standard deduction will be for the taxpayer. So again, when you're a dependent, the standard deduction changes depending on whether you have all unearned income, which that's the case here, or you have earned income, like the summer job for the 16-year-old example, right? So we have dependent child here, dependent. Unearned income is the only thing on this return, so the only standard deduction we're getting is $1,100. Okay. Now here we see the again the $3,485, which comprises some interest of $60, ordinary dividends $2,350, capital gains from the sale of stocks were $1,075. So we got $3,485. There was also some tax exempt interest in there, but notice that's not included in the total unearned income computation because it's tax exempt interest, right? So you can't leave that off. So when we have our 3,485 number, that is first reported on the 8615, right? So line 1, child's total unearned income, 3,485, okay? Now for line 2 here, it's asking us if the child didn't itemize, just enter 2,200, right? So that's obvious, right? The child doesn't have any itemized deductions, right? He's 6 years old. So we've got $2,200 as the deduction here. And so that is effectively the floor, right? And so any amount of unearned income over that is the piece that's effectively going to be subject to tax here. So subtract line 2 from line 1, and we've got $1,285, okay? So child's total taxable income pulling through from the first page on the 1040, $2,385, and then the smaller of the two numbers is the unearned income excess, $1,285. So part 1 is relatively simple. Part 2 is where it gets a little more tricky. So the first 2 points I want to highlight here are where we're pulling information from the parent's return. So remember, we have John's tax return in front of us. What are the numbers and where they're going? $202,718, this is the number that is coming from John's tax return. So that is his taxable income number. And then on line 10, $45,322, that is the number coming from John's tax return. So that's the total taxes he owes. So line 6 and line 10 are coming from John's tax return. And then the rest of the fields are filled in based on the information we have in front of us, okay? So line 8, it's asking us add up lines 5, 6, and 7. So what we're doing here is we're taking the amount of unearned income in excess of that exclusion, $1,285, and we're adding it to John's total taxable income on his return to get an adjusted taxable income figure for John. Because remember, what we're trying to figure out here is what would this income have been subject to tax if it were being reported on John's personal return. And so by taking what he had on his return, adding that extra amount, now we're getting kind of an adjusted balance, and then we compute the amount of tax that would be owed on this adjusted amount. So the $45,964 is the adjusted amount. The $45,322 is what's actually on John's return. And then the difference there is that excess, right? That is the kiddie tax portion that gets added to this return. Now the child's tax section down here, this is where we reconcile, again, the kiddie tax versus the amount of tax that would have been computed on the kid's return had they filed by themselves and they didn't need to report this kiddie tax computation. Right, so based on the child's filing status, if we use the qualified dividends and capital gains tax worksheet, the amount of tax that would have been owed would only be $11. Right, and that's, again, remember, the income is very low. $3,400, you took off $1,100 for a standard deduction. When you only got $2,000 in income, the tax on that is going to be low. So that's the $11 that's being calculated here. But again, because of the kiddie tax, we need to factor in the rates that would have been applied at the parents' level. And so that's why line 18, it's asking us to use the larger of the two. Right, so in this case, we're using the larger 642 over 11. And so $642 is ultimately the amount of tax that's going to be paid at this level by the child. So line 16, the tax amount, $642, rather than that $11 that otherwise would have been reported as the tax amount, if we didn't have this kiddie tax computation issue. Okay, so let me see if there's anything else I want to touch on here that's important. No, I think that covers it. I mean, I think the messaging here again is there's still a lot of utility in having income shifted to your children. 100%. I have clients that we do it for all the time. It's good for asset protection, good for estate planning, and in a lot of cases it does result in overall lower effective rate, but it's not going to be so low. Right, so it's not going to be, the zero rate that you're thinking of because, oh, my kid doesn't have any money, so they can earn some income and not have to pay tax on it. No, there's going to be some tax exposure, but it won't be as bad if everything is just being reported on your personal return. So, okay, so that covers it for the 8615. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again on the next video. Okay, thank you.